Thanks for joining us at PhillipCapital Market Watch. I'm Wei Wei, an Equities Specialist from Phillip Investor Centre. Today, I will be sharing what are the sectors to look out for in the current environment. Last year, the Federal Reserve believes that the inflation is transitory due to supply chain issues and pent-up demand. From the consumers due to COVID restrictions. However, in the past CPI data in 2021 shown a nearly 7% increase in the reading, the fastest pace in nearly 40 years, indicating a heated economy, as CPI is indicator that measures the cost of fixed bundle of consumer goods relative to the cost of those same goods in the chosen year. Strong consumer spending could be due to the US relief plans for their citizens. According to Federal Reserve Q3 flow of funds report, the average household net worth rose 2.4 trillion to 144.7 trillion in Q3 2021, with higher net worth of individual household coupled with double-digit returns from the US equities in the past years. Demand is likely to be sustainable. With the strong economic backdrop, Fed Chairman Jerome Powell is discussing decelerating its purchase of treasuries and mortgage-backed securities and may start its first rate hike in March 2022. Even though we are not able to predict when the rate hike cycle will start and how many rate hikes in 2022, but analysts are expecting at least one rate hike in 2022. Then the question becomes, what do we expect the stocks to perform during the rate hike cycle? Some investors may be cautious towards the market as rate hikes generally are not good for equities. One of the measures for stock valuation is discounted cash flow. With a higher interest rate, the share price may be compressed. However, according to RBC reports, for the past 17 rate hike cycles since 1954, the probability of a positive return from the stock market 12 months after the first rate hike is 76%, and the average forward return is about 7.8%, meaning there are still pockets of opportunities for investors to look for during rate hike cycles. The more recent rate hike cycle was back in 2014, where taper starts in early 2014 and interest rate hike in late 2015. Since we are currently at the tapering stage, we may draw reference to the sector performance in 2014. Generally, it was quite a good year back in 2014 with utilities and healthcare leading the way, returning more than 20%. During the phase of tapering, it would be better to stick with defensive stocks like utilities and healthcare and consumer staples. This chart shows the historical sector performance for pre- and post-rate hikes. Evidence shown that it is better to own companies with pricing power like the utilities company, as they are able to pass cost increment to the end consumer, not to erode their profit margin. Even though technology companies perform quite well pre-rate hike and the drawback is not that significant post-rate hike. Investors have to take note that these technology companies are referring to companies with earnings. Please do not enter into companies with no earnings, as rate hike will further increase their costs and lengthen their time to make profit. That's all for PhillipCapital Market Watch. Do remember to like and follow us on social media and subscribe to us on YouTube.